Today's guest is Matt Smith, who is a senior fund manager at Ruffer. Ruffer is based in the UK and has been managing a single absolute return strategy since 1994 and manages about $30 billion. I've been looking forward to this conversation because I view Ruffer as an excellent macro investor, has great perspectives, is also a student of financial markets history. Matt, thank you for joining me today.
Thanks, Alex. Great to be here.
Let's kick it off with some of your background. Unlike many of your peers who studied economics or finance, you studied history. Would you tell us about that and what originally interested you in markets?
Yeah, of course. It's not the typical background for financial market investors. I mean, I think what's so interesting about history is that fundamentally it's the study of the cycles of change and the study of tipping points. At university, I studied first the Enlightenment and the scientific revolution in Europe in the 17th and 18th centuries. And, there were some true regime changes through that time. Things like heliocentrism from Copernicus, the heresy of its day. What made for such fertile ground for change? What was it about the structure of the countries and the institutions that permitted that development? And I wrote my thesis, or did the major part of my university study on American history, actually, on the economic growth that the US went throughout all of its history, really, how it grappled with that. As you came into the 20th century, you had a boom, then a war, then a short depression, then a boom, then a big depression, then a war, then a boom. There are these clear economic cycles. There are clear societal impacts of that. Why do you have these tipping points? Why do you have these recurring cycles? And how can you identify them? And for me, that's why I think for successful macro investing, history is essential. Markets are mass psychology, really, nothing more, nothing less. And the idea that computers or algorithmic investing dulls that, I think is wrong. If anything, it amplifies it. So what is important is not really so much seeing why events transpired the way they did, but seeing and reading about how people felt at the time. Because typically, when faced with similar circumstances or similar incentives, humans react the same way. But you can only identify those pressures in real time or today if you know what people in 1929 were themselves feeling at the time, not what we've transposed onto them later. Secondly, it gives you the possibility to imagine what might be coming. Humans aren't good at forecasting, really. Well, it's kind of impossible, but they're not very good at dealing with or expecting change, especially big change. And ultimately, macro investing is about change, rates of change. And I think the more you've seen of the change that's been possible in the past, the better prepared you are to imagine the change that might be coming in the future. More on which later, I expect, if we get to talking about inflation. And I'm conspicuously not a mathematics expert. Most good investors are either exceptional at qualitative analysis, they're genuine bottom-up business model focused stock pickers, or they're good analysts of company management or of sectors, or they are highly quantitative investors. They're in the business of expert regression or constructing successful algorithms. Neither of those, I think, can be the answer in their own right. Maths, after all, is only a model. And people who are friendly with maths like to derive certainty from numbers, but it is, in my view, it's almost always a false certainty. I've learned through time that the truly great investors they're good at both. They're comfortable in the qualitative or the quantitative, and that means they can understand the limitations of both, and they combine that with an all-consuming dedication to markets and to study. A relentless curiosity and humility. I can't claim to do any of that, but that's why I think it's neither an advantage nor a disadvantage to have studied a qualitative subject. The reason I came to markets was because I love that ultimately investing is a debate with an impartial, unarguable judge in the form of the market, and the score is kept on a minute-by-minute basis. And there's no wrong or right, except the price you paid and the price you sold at. And you can be wrong and make a profit. You can be right and lose money. Things that are obvious are usually bad investments, and things that don't make sense can be 100x VC type returns. I don't think there are any other disciplines really where you get those kind of dynamics. And so that's what I love about it. It's relentlessly challenging and interesting.
It's a very interesting craft because you essentially can't master it because it's constantly evolving. And if you feel like you have, then you're most likely overconfident and really probably expose yourself to outsized risk.
The market will let you know about that pretty quickly. And that's the beauty of it. The rarest quality in investment is endurance, because hubris, is met by nemesis. The moment you start to believe your own hype, then you need to be prepared for the fall.
How would you say your investment philosophy has evolved through time? Perhaps what was it like before you joined Ruffer, and how has it changed since you've been at Ruffer?
I think it'd be too embarrassing to talk through what it was like before I joined Ruffer. I think my earliest memories of investing were reading the Man United share price in the newspaper each day and wondering what on earth was going on there, except that I liked the name. What I've learned through 13 years of being here is that there are two big things, I'd say. The first is the importance of a balance of personalities on your investment team. And if you are a detail-oriented person, then you probably need alongside you a big picture type person to make links and to join in observations together in a way that you might yourself not be able to. If you are a quick thinker, you're prone to joining things that maybe ought not to be joined, then you need someone more forensic to sit alongside you and trust but verify the observations that you're making, that you're using to make decisions. I think that's a big part of our success is that it is a team game. That's not to say that the decision making isn't narrowly held, but we like to talk about a democracy of ideas and an autocracy of decision making. You want a good balance of people contributing to a decision, and then someone has to make it. The second learning has been the importance of triangulation, and it relates to the quantitative, qualitative point above. Your macro idea, your trade idea must, to my mind, be triangulated. If it's a qualitative idea, can you use a quantitative approach to verify it? And I agree wholeheartedly with Stan Druckenmiller. You can't go big in an idea until the chart supports your decision. If the analyst likes it, the computer likes it, The sell side analyst will admit to liking it in private, but not in public. You can see the rate of change is coming your way, but the chart still looks awful. Then you need to have a position, but you can't get too big in it. I think with stocks, with asset classes and macro positions, you can use a mixture of triangulating techniques. Fundamentals are very important. Valuation is very important. Sentiment is very important. The more things you have lining up, the bigger your position can be. But if there are important ones missing, then no matter how sure you are, you have to keep that position size under control. And that's how you avoid value traps. It's how you avoid things that have a irresistible valuation, but that is just the market saying this is continuing to go downhill. And I've learned that the hard way. And it also helps keep you in positions for longer than you might otherwise, especially if you are contrarian, as we typically are.
Matt, 70% of our listeners live in the US. Obviously, Ruffer is located in the UK, and so many of our listeners may not be familiar with Ruffer. Would you share some background on Ruffer and its core principles?
So we were founded in 1994 by our now chairman, Jonathan Ruffer, with the antiquated philosophy that people like making money, but they hate losing it more. And you, in your first podcast on this series, you said, when I think you were interviewing yourself effectively, you said the risk of permanent capital loss should always be priority number one. And that is certainly true for us. We have a total focus on capital preservation. Our primary investment objective is to avoid losing money on a rolling 12-month basis. Now, I'll come back to how that impacts portfolio construction, but that's the starting point. It's a sort of comically unambitious target, and it's accompanied by a secondary objective to deliver returns significantly ahead of cash, to justify taking risk in the market, to justify charging a fee. That focus on not losing money, on true absolute returns, has allowed us to deliver around 8% a year net of fees for 30 years. And we've delivered positive returns in all four of the major bear markets in that time. The dot-com bust, the credit crisis, March 2020, i.e. the COVID period, and 2022. It comes at a cost, of course, of underperformance in the good years. And psychologically, those can be difficult for us and for our clients. But we feel that a capital preservation focused approach is the right one for the way we think about the world. It's the right one for our clients. And actually, over the long run, we find that it does better than bonds, does better than equities, and the combination. Now, that how we compare to them varies through time, especially towards the end of what we might consider to be a bull cycle. But perhaps most importantly of all, it allows investors to sleep at night knowing that they're not going to wake up with half of their money gone.
It makes a lot of sense. And oftentimes what I found is investors forget priority number one is to preserve capital when you've experienced a strong bull market for a while. That seems to fade to priority 3, 4, 5 until something bad happens. And all of a sudden it jumps to priority number one, but by then it's too late. And so I guess part of the challenge is reminding people that that's the goal and the importance of it and the way the math works. You lose money, it's so hard to get back to where you began.
That's exactly it. Famously, Einstein described compound interest as the most powerful force in the universe. If you can deliver 2% a year twice, you are still a lot better off than a portfolio that loses 50% and then is up 100%. We just think it makes your life a lot easier and your return compounding more powerful if you can avoid the losses. I think if we're doing our job well, we like to participate appropriately in the bull phase of markets, typically getting off the bus a few stops too early, and that is the stressful point for us. But then by electing not to hold the things that are doing best, we're typically able to deliver small positive returns in the crisis period for markets, and that gives you both an even portfolio keel basis from which to operate, but also gives you an even psychological keel to be making decisions from. And that's very powerful. You're not suddenly falling victim to all of the behavioral instincts that humans have to deal with when they're faced with loss. And so we can be a provider of liquidity to distressed markets. And that's when you can get truly great risk reward opportunities, to be the other side of panic. And the price of being able to do that is that you also have to be the other side of greed. You cannot hope to do as well as everyone else in the bull market.
One of the questions I often ask investment managers is, what business are you in? And I think of it along a spectrum. On one end, in the business of gathering assets. On the other end, in the business of generating returns. Now, every manager will answer, we're in the business of generating returns, but you have to look at their actions. And when I look at Ruffer, you've offered one fund in 30 years. And that's pretty unique. Most firms have multiple funds, and whatever's doing best that's what they market. So to me, it seems that if you've only offered one fund in 30 years, that you're more likely on the generating return side of that spectrum. How do you think about that?
As predicted, I think we're a returns-focused business because, as you say, we've been a single strategy company for our entire existence. We have different vehicles for different jurisdictions, and it was only 2 years ago, at the beginning of 2022, that we launched a vehicle for the US market, and hence we're less well known there, exactly as you say. But the rarest quality in asset managers is typically durability, and that's what we're solving for, of client capital and of our business. We don't want hot money. That's typically what breaks investment businesses, is outflows at the bottom of your performance cycle. And it's something, as a side note, it's something that I have found US investors to be much better at than the rest of the world, is counter-cyclical manager selection. It's very easy to allocate to the people who are performing strongly. In the US, people seem more inputs focused than purely performance or outputs focused, which is fantastic. We don't want any constraints on our ability to construct portfolios. So we don't do any kind of explicit asset gathering. That tends to be easy come, easy go. And we're a private business owned by partners such as myself. So we don't have any external shareholders asking for AUM growth. We don't have a benchmark, so we're not forced to own something we don't like. We don't have a performance fee, so we're not forced to take risk if we don't think it's appropriate. And we don't use leverage, so we're not forced sellers in a price decline. So we're trying to keep the constraints as low as possible.
Managing risk is a critical part of your process, and you've talked about that a little bit already. And I've heard Ruffer referred to as a hedged fund rather than a hedge fund. Would you talk about how you think about minimizing risk, minimizing regret, but while at the same time trying to maximize return? How do you accomplish all those at the same time?
It's pretty simple. Most of the industry, they scour the investment universe for the best return-seeking opportunities, stack them up, and then does some kind of risk management through diversification or VAR analysis or whatever it is. It's definitely secondary. We flip that on its head. We start from the perspective of risk management and then begin by putting in place the assets that you'd want to hold to protect against the risks you see, and importantly, risks that are underpriced. Now, if we just did that, we'd be a kind of eloquent tail hedge fund. So we then think about, well, what if we're wrong about those market risks? What if we're wrong about the timing of them? How do we offset those protective assets? Enable us to stay in the trade effectively until such time as it's called upon. You would think that people would be better at predicting how markets behave. We don't think that's possible, actually. So we don't do it. We try to construct portfolios using offsets. So you have protective assets for the risks you are worried about, and then what we call typically growth assets on top, kind of encasing them. And whichever side is called upon, you hope through solving for asymmetry in your security selection does better than the other side, contributes more than the other side loses. And so you don't mind whether you're on the bull tack or the bear tack. Overall, you have an all-weather portfolio.
So is that how you distinguish risk management from market timing? And I've heard you refer to this or separated this conversation or this topic in the past, where there is a what and there's a when. And the what is what you think is going to happen next, and the when is when you think it's going to happen. And the when is really hard to predict, and the what is probably easier to predict. Would you talk through those points?
That's exactly right. Predicting the future is composed of two component parts. What do you think is going to happen, and when do you think it's going to happen? So with a deep enough understanding of financial market history and a deep enough understanding of current markets, we think that you can have a good view, a good chance of being right about the what. That's typically the structural time horizon stuff. So that is primarily what is the direction of interest rates and inflation. Are they structurally rising or falling? Are we in an inflationary world or a deflationary world? What is the regime context of the current market? Are we in a world where there is a clear desire to squeeze inflation out of the system, to be orthodox in monetary policy and fiscal policy, or is it the converse? Is there a bias to loosening and to, for example, lower real yields? Guessing the when is empirically impossible. Predicting the future is impossible. So we just stick to the what, and it'd be great to come on to what our structural views are. We construct the offsets in the portfolio by thinking about the cyclical time horizon, by which I mean kind of 3 months to 18 months, and using that to calibrate the offsets in the portfolio to solve for this all-weather return profile. And the way we look at the world on a cyclical time horizon is through kind of simple 2x2 axis of economic fundamentals and financial market liquidity. Fundamentals is pretty simple. That's basically, is the economy going up or down? Are corporate profits going up or down, etc.? Liquidity is not the way most people use it, i.e. kind of the ease of trading. Is there money coming into or going out of financial markets? To put that into a way that you can understand, I think of it as, how do prices react to data? If the money supply is expanding, credit supply is expanding, and there's money coming into financial markets, then overall prices will react more positively to a given data point than if the converse is true. And it gives you a good lens for the last few years. Coming into 2022, we had a strong view that fundamentals and liquidity would deteriorate. And so we positioned the portfolio accordingly. That's what happened through 2022. And in 2023, we thought that those dynamics would persist, that the economy would slow and liquidity would be withdrawn, faced with a 5% interest rate. And of course, that's not what happened. And we can come on to 2024 in a bit, but that fundamentals versus liquidity axis is how we would think about things today. And typically, that's the bit that people can easily miss with investing. They can have very good view of the fundamentals, be very detailed in their economic analysis, but you have to think about the things that impact liquidity, like risk appetite and positioning, sentiment, credit supply, all of those kind of things.
Part of risk management is imagining the unimaginable and all the bad things that can cause investors harm. But the challenge is if you're always thinking about those things, you could suffer from paralysis and not take any risk. And obviously, there's always a lot to worry about, maybe today more so than normal. But history tells us a lot of these risks don't actually materialize. So, how do you take all that in and still take risk to earn returns through time?
I think that's especially true. Markets are they're always afraid of something. The phrase is that they climb the wall of worry. Throughout history, people are always worried about something or other. And it can be difficult, right, to say that's a risk I'm willing to take on. But that, I think, is the beauty of our offsets approach to investing. You put in place assets to protect against the risks that you are worried about. And then you put in place, on top of those, assets that will do well if the sun is shining. So the skill is not in predicting what the weather will be tomorrow. It's about predicting the atmospheric conditions over the next few years. And it's also in security selection. Can you get that asymmetry? And the problem with asymmetry is that it tends to mean you have to buy stuff that's unloved and you have to sell stuff as it becomes loved. But that's what that triangulation process, I think, is so important for, is telling you, look, this, you're right about this and it's working. So stay in it for as long as you dare. That's the hardest part about investing, right? Is selling the things that you like because you should, and buying things that everyone, including the market, is telling you they're a bad idea.
And that's because you're more likely to buy it at a good price. And I've heard you say in the past, you can take a great idea, buy it at the wrong price, and it's a terrible investment, and vice versa.
I mean, that's the brilliant thing about financial markets, right? The capital cycle is pretty unique. That a good idea can become a bad investment. The mental flexibility you need to cope with that is high. You need to be able to say, well, look, I can see that this is going to be a very important phenomenon for the next 20, 30 years. But the marginal return on capital that I would be getting by providing capital to that idea, industry, investment is not as good as this idea over here that everyone thinks is dead and buried. That is a sort of a fancy way of saying momentum can be quite a toxic force in financial markets. And we live in a very momentum-dominated market these days.
So with this idea of owning assets that might do well in different environments is also related to diversification. How would you relate the two, or do you think of them differently?
I think the key, so diversification has a role to play. I think especially at the asset allocator level, I differentiate from the asset allocation level, because it is a skill to be able to put your eggs into a small number of baskets and be comfortable with that, and to select them well. And typically, that, I think, that is something that's best left to the professionals, as it were. So that that is that's what we do. We're diversified through offsets. We're not diversified by owning a wide variety of asset classes just for the sake of it. And so that is the counsel that I would give to asset allocators, is to think about, am I really diversified? And that means thinking about the sensitivity of the assets in your portfolio to interest rates. if you have lots of interest rate sensitive assets in the, let's call it, low vol part of your portfolio, so bonds, infrastructure, real estate, and in the equity part of your portfolio, you also have assets that are sensitive to interest rates, but you don't realize it, such as levered private equity or highly duration sensitive equities, ones with a great deal of cash flows into the future. Then you're not as diversified as you think you might be. You might have more interest rate sensitivity in your portfolio than you thought, and that's what 2022 was quite a neat encapsulation of. As the saying goes, there are bonds in the stocks sometimes, and you have to be careful of that. You also need to be diversified, I think, from a volatility perspective. Most assets are short vol. Some are short vol explicitly, but most are short vol implicitly, i.e., they go down as volatility goes up. And that sort of implicit short vol component is often ignored. And so, if you look at markets that way, if you think that almost all cash assets are short vol, then it makes sense to have assets that are long of volatility, that rise as volatility does, in your portfolio, just to provide some diversification through that lens. Chris Cole wrote an absolutely seminal piece on exactly that in 2017, called, I think, Reflexivity in the Shadows of Black Monday. And just about the importance of constructing a portfolio that has long volatility components in it. And certainly that's something that we think about a lot.
You said two things there that I think are extremely insightful, and two mistakes that I've seen investors make over the last 25 years since I've been in this industry. One is high confidence that they can predict the future. So we've covered that in a few places. And I think part of that is just having selective memory. You make calls in the past, and the ones that you guess right were due to skill, and the ones you guess wrong were due to bad luck. I think that's part of just human nature. And the second is, we've all learned, don't put all your eggs in one basket. Diversification is the one free lunch in investing. Yet most investors, in my experience, are not well diversified, yet they feel like they are well diversified. And I feel like those two mistakes often are the root cause of unnecessary pain that investors, deal with over time.
It is very simple to tell whether you're diversified or not. Look at your portfolio returns through 2021 and 2022. If all your assets went up in 2021 and they all went down in 2022, guess what? You're not that diversified. And that's not to say that you won't get good returns from being that way. But it is to say that you have much more risk on one side of the table than you might have thought.
That's for sure. Let's talk about financial markets history for a moment. You studied and are passionate about history, financial market history over the last 13 plus years. And my sense is that most investors are not well aware of financial market history, and therefore may not have the same perspectives as someone who has deeply studied the past. What would you say are the most important lessons that you like to share about financial markets history with our listeners?
The difficulty here is going to be keeping this short, because this is what I love. This is really where I get most excited, is reading books about the past, often old books, the perspectives on the past from the past, and you think, these are such elemental lessons that we have forgotten because things have got very numerical. The metrification, or whatever the right word is, of economics. So what are three good lessons? The first is around mean reversion. And that was, you had Jeremy Grantham on here with a sensational podcast earlier in the year. And he is, he's a mean reversion guy. And I think he's totally right. That's generally an excellent principle on which to base your investment thinking. But a study of history can help you understand why mean reversion can be suspended. because it can be, right. We're in a period where it is currently being suspended, and as he said, that will change, but it hasn't helped him over the last decade or so. The study of institutions in particular can help you, I think, get a better understanding of why mean reversion can be interrupted or why it can be excessive. Anti-competitive forces, the power of the government in the economy is a very important one. It can bring you to a greater understanding of the great waves of inflation and of populism, of capital versus labor. I think it's instructive to think about differences between the Gilded Age in America and the 1970s in America. In one, you had a lot of very significant technological development and pretty, in fact, almost non-existent anti-competitive forces in very small state, very high returns to capital, a lot of wealth concentrated in very few individuals. And in the 1970s, where almost the reverse was true on every front. Returns to labor were much higher than returns to capital. Certainly, the pendulum was swinging hard that way. Union power was very significant. Returns to capital, if you invested in the bond market, were terrible, truly terrible, and not much better in the equity market. Populism was very much in force. What are the things that drive that? Because governments and populations have the power to suspend mean reversion. And which of those sounds closer to today? We can come back to, but I think I know where we're headed. So that's the first lesson is mean reversion is the guiding principle, but it's very important. History can help you understand why that principle can be suspended. Secondly, it's very important for understanding money. And at Ruffer, we commissioned a book written by Edward Chancellor called The Price of Time. And it is a superb and very interesting history of interest rates. And I know that sounds like a paradoxical concept, but it shows you that there's nothing new under the sun when it comes to finance. QE and zero rates are technically an innovation. And certainly that's how everyone thinks. But through huge parts of the medieval era, the charging of interest rates was banned by the church in Europe. It was a full zero interest rate era, and the thinking was that if you had interest rates other than zero, it would cause all of the highly indebted landowners to go bankrupt, and the highly indebted landowners who were kind of in power didn't want that. And to me, that's absolutely no different to the post-global financial crisis era, when it was kind of acknowledged that raising rates would bring down some of the highly levered edifices, not least the government. So why would you not have zero rates if you can? The people in power and the people with the economic models always like zero rates because A, it tends to benefit them, and B, in economic theory, the lower the rate, the better the economy will hum along. So zero rates are not new. The ability of governments to debase the currency that they spend in order to fund more spending than they bring in through tax is as old as the concept of money itself. As soon as you understand that, really, it's kind of, it becomes extremely clear that governments will always default towards inflation. They will always default towards currency debasement if they can get away with it. There has to be a defining ethos in a country where the population is truly fed up with inflation and effecting regime change, as in at the top, to deal with that. That tends to be the only time that you end up with hard money policies. in the full franchise era, I would say. There were obviously times, there were long periods, especially through the 19th century, where very hard money policies were run, but there wasn't a full franchise democracy in the same way as today. And that, I think, leads you to the third lesson, which is that hard money is typically denied to people by the government, if at all possible. In the 15th century, the governments of Europe, on the whole, made the only coins that they made available to the wider population were made out of copper and sometimes silver. Those are not metals that have a very restricted supply, especially if the price goes up a bit. And so really no one had a way of preserving their wealth through time except the elites who had gold. Typically, when gold or hard money becomes a difficult issue for governments, they start to do something about it. I certainly don't need to tell you that living in the United States, where private possession of gold was made illegal from 1933 to certainly 1971 with the end of the gold window, but I think it persisted longer than that, which is why silver has such an important, silver is a much more important metal in the United States than it is in the UK, because it was seen as an alternative. So yeah, those I think would be my three lessons. You must understand the institutional framework in which markets are operating to understand how quickly one should expect mean reversion. Secondly, that governments will always try and spend more money than they tax, unless they're explicitly mandated to do the opposite by the voting base. And thirdly, and it's related, it's extremely inconvenient for governments if there's a readily available hard currency alternative for the population. And I think that does lead you to discussions about things like gold and Bitcoin as investments.
One of my observations of history is countries tend to go through this typical life cycle. They start poor and they know they're poor. And then they start to become rich, but they still feel that they're poor and they spend like they're poor. And then they realize they're rich and they are rich. And then eventually they're poor, but they still feel like they're rich. And it seems like as that happens and you hit that last phase where you feel like you're still rich and you want to stay rich, but you're actually poor, that's when you start getting some of those, the printing of money, debasement of currency, trying to extend your debts. It's really fascinating how those cycles just repeat through time.
I couldn't agree more. And most successful empires throughout all of human history have been based around a gold-denominated coin. And I'll get my history wrong here, but the Romans had a solid gold coin. The Byzantine Empire had a solid gold coin. The British had the sovereign, and the US had a dollar on the gold standard. That attracts capital, keeps capital allocation honest and efficient. But eventually, as you say, you get overspending or inefficiency, and that solid currency begins to be chipped away. There's a quote from the philosopher John Locke from 1691. And he says, roughly, if ill husbandry has caused a nation to waste its wealth, then the cutting of interest rates simply increases the amount of money. It does not bring back that wealth. And, he knew that 350 years ago. If you've done bad capital allocation, you can't just cut rates and hope that will fix it. If anything, as you say, that makes things worse by causing people to feel richer, but delays and prevents that important recognition moment when people go, okay, that capital was badly allocated. We need to kind of write it off and start again.
When you look at history, what period would you say most closely parallels what we're going through today and perhaps where we're headed?
That's a very easy one for me. And that's the late 1960s, which probably tells you a lot about where I think we're headed. You had a period coming out of the Second World War. And the Second World War was a time of locked down travel restrictions and destruction of supply chains. In the post-war period, you had transitory high inflation. And, it was correct to say, don't mess around too much with policy settings. Inflation's gone up, but it'll come back down again as supply chains heal. And it did that. It went from kind of 10 to 0 and back again a few times. And through the 50s and 60s, you had very high real economic growth, high levels of fiscal stimulus, and a view that you could control the business cycle with correct application of fiscal and monetary policy. But slowly, the system was becoming more inflationary. Spare capacity was reducing, or slack was reducing. Economic growth was picking up, and unemployment was falling. And I'm going to quote here liberally from a speech by Arthur Burns in 1978, i.e. post the experience of the 70s.
And he was the chairman of the Federal Reserve at the time.
Yes, exactly right. So, he's got an incentive to be pretty, to blame other factors than himself. But I think the clearest thing that you can learn by studying central bankers through time is that none of them, and I mean none of them, are independent. They're all products of their time. So, to attribute any kind of power really to any of them individually is, I think, a waste of time. They do what the popular and political atmosphere around them permits them to do. And that was exactly Burns's point. He said people over time came to see the government as the solution to all of their problems. And he specifically says quite what an inversion that is of the American mentality through all of the 19th and early 20th centuries, where it was very much, you're on your own and pull yourself up. You had excessive fiscal and monetary stimulus, thanks to the Vietnam War and the Great Society Program. You had crop failures in 1973 and the OPEC price shock in 1974. So, we were familiar with all of that. Zero rates, a lot of QE, some fiscal through the IRA, the CHIPS Act, the CARES Act. And then with Russia, Ukraine, you had rising food and energy prices. And he says two things were critical. The goal of the Federal Reserve and the federal government was to promote maximum employment, not price targeting. And I think implicitly, that's where we are today. And secondly, budget deficits, as a result, were incurred, I quote, when business conditions were poor and also when business was booming. I think the fact that in a presidential election year, when the budget deficit is at, 5, 6, 7%, no one is talking about that. That is almost, the single most important piece of evidence pointing towards an inflationary future. Neither candidate is saying, I'm the fiscal rectitude candidate. And that's exactly what was going on in the 70s, right? The solution to rising inflation was more spending. And we have that again today. When energy prices went up in 2022, the response of the UK government and the European government was to spend money to prevent prices rising. And if you understand anything about how the price mechanism works, that's a bad idea. And the same was true in California. I think you guys had gasoline subsidies to prevent the price rising too much. I'm actually not saying that was a bad idea. And I think they would say, look, we've been vindicated. It helped smooth a temporary price spike. My point is that tells you so much about where we are today psychologically. And that's really what matters, is what is the attitude of government and the voting public towards inflation. It's a very simple question you have to answer. Do people hate the pain of dealing with inflation, or do they hate the pain of inflation itself? Which do they hate more? And I think there was a period in 2022 when people said, well, yeah, this inflation thing really is a problem. Let's deal with it. But as it came down and you had a banking crisis as a result of the tightening, quite quickly everyone went, ooh, I think we don't want the pain of dealing with inflation, thanks. And it seems to be resolving itself in the background. So let's take our foot off the brake. And I think where we are today, people hate the pain of dealing with inflation a lot more than they hate the pain of inflation. And you will get inflation structurally until that is no longer true. The Gerald Ford campaign included in October 1974 something called WIN, whip inflation now. And these were kind of the badges that were handed out. It was a sort of a signature policy, and it involved things like carpooling, turning down the heating in your house. Really sort of pathetic kind of macro pru, I guess, ways to deal with inflation. Anything to avoid actually hiking rates. And that was at a point where inflation had averaged 6% over the previous 5 years. Today, it's averaged 4% over the previous 5 years. So we're not far off. But that was in 1974. They just didn't do anything about it. And over the next 5 years, inflation averaged 8%. That was the point at which people decided we've had enough. We're electing a president focused on deregulation and supply side reform in the form of Ronald Reagan, and a central banker who is willing and mandated to hike rates until the monetary aggregates start contracting, until inflation is under control. And they imposed tight money policies through two hard recessions. I always like the quote that Volcker had coffins left outside the Federal Reserve building made out of 2x4 planks that were put there by bankrupt home builders. And he had, car keys posted through his mailbox from car dealers who'd gone bankrupt. That's what tight monetary policy really looks like. Even if you think we're in 1974 today, it took another 5 years of very high inflation before people were willing to elect someone who would deal with it. And I think we're miles from that today. If I had to summarize where I think we are today with regards to inflation, which is possibly the most important macroeconomic variable, I would say that we have moved from a ceiling of 2% on CPI to a floor of 2% on CPI. And that is a true regime shift. It doesn't sound like very much, but the asset allocation implications are very significant. And I think we've seen one cycle of inflation. We're going to find out quite how far down inflation comes again. How sticky does it prove to be? How much do the Federal Reserve really care about getting it right back down to 2? Are they willing to impose the true tight monetary policies that are needed to do that? And I think we will learn a lot once that tightening cycle comes into contact with the enemy. There are 3 enemies. The first one is interest costs. Your own Congressional Budget Office says that interest costs are nearly 20% of government revenues today. And actually, in the fiscal year to date, the US government has spent almost exactly the same amount on interest as it has on the armed forces. But basically, on the whole, the whole defense budget, and basically through thousands of years of economic history, when that happens, when interest costs rise a long way up the national budget line items, the government does something about it. Either it cuts rates, or it starts to enact policies to force down the rate of interest on bonds. We're very familiar with what those are. And then we will, I think that the true kind of inflation fighting credibility of the Fed will be revealed at that point. And that actually, incidentally tells you what our structural allocation in the portfolio today is, which is inflation-linked bonds and precious metals. Inflation-linked bonds currently price a 30-year inflation rate of 2%. That is completely unchanged from the pre-COVID era. And that is essentially a vote of confidence in central banks, saying that they are independent, they'll do what it takes to get inflation back down to 2, and they'll hold it there. And for all the reasons I've described above, I think this is the late 1960s, and I really want to take the other side of that 2% view.
The interesting part about the 60s and 70s period compared to today is we can look back and see the lessons learned from that. And I'm curious what your thoughts are about the Fed today not wanting to repeat the mistakes made in the 70s and letting inflation run too hot for too long before hiking rates, and short-circuiting that process by hiking rates relatively quickly after inflation spiked. Does that end that cycle, or does it just delay that inevitable inflationary impact?
I certainly have to acknowledge, if you had asked me at the beginning of 2022, what would happen if the Federal Reserve tightened to 5% interest rates and held them there for 15 months, as at today, I would have said bad things will happen. This is not an economy, more accurately, or more importantly, this is not a financial market that can cope with a risk-free rate of 5%. Yet here we are today. It clearly has done. And that is, I think that's pretty extraordinary to my mind. Now, there are some mitigating factors. There's been very powerful fiscal stimulus. The rate of change in terms of interest rate hikes has slowed a lot. So rates volatility has come down, and markets are forward-looking. They can see that inflation has gone near enough to target. They can start to price interest rate cuts. But still, I think it's important to acknowledge that only the government is a borrower at 5% interest rates. So right now, through 2023, there was almost no equity issuance. There was very little debt issuance in the corporate sector, but there was a heck of an increase in government debt. This year, credit issuance has gone up for sure, reflecting quite tight spreads, and equity issuance has risen as well. But still, it's really dominated by government borrowing requirements. And as we know, cash levels in money market funds, for example, have gone up enormously, reflecting the fact that a 5% risk-free rate is pretty damn attractive. So if no one can really make the economics work on borrowing at 5%, eventually you'll do some damage. It's taken a lot longer than I expected. The question is, if you start to see some economic weakness, and I think that is probably the right axis to be thinking about things right now. That's the place where the market could be most surprised. I'm not an economist, but the constellation of data points that are coming out do seem to be pointing towards incrementally weaker economic growth at a time when that's kind of the one thing that people have assumed to be constant. Everyone's been very focused on inflation and is it coming down or not? And growth is just assumed to be pretty solid. That would be a surprise to a market that has taken it for granted. And we mustn't forget the importance of reflexivity in a modern, hyper-financialized economy like the US. If your stock price is going up, you can pay your employees more cheaply through stock-based compensation. You can buy companies more cheaply through all stock purchases. And CEOs are more confident. They take the share price as an input into their capex decisions, into their hiring decisions. So there's a huge reflexivity to asset prices, especially in the United States, and that potentially makes the economy very vulnerable to a slowdown in markets. If you got that at a time where the economic fundamentals themselves were also weakening, then you could have quite a sharp sell-off. And that, that's not something we're worried about imminently, but it is something that, because we don't like to put too much emphasis on timing, it is something that we're positioning for in our portfolios today.
If we zoom in a little bit on financial markets history, one of the big phenomenons today is this AI boom. And there's been a lot of parallels drawn to the internet boom of, call it 25 years ago. How do you think about those two relating to one another? And is your sense that that AI boom is going to end in a similar way as the internet boom did?
What I've found so interesting about AI is it's very difficult to find anyone with a balanced opinion on it. The people who understand it, who truly understand it and are part of its creation, are kind of limitlessly optimistic about what it might do. Elon Musk talks a lot about AGI. So does Sam Altman. If they're right, that's you don't want to be shorting that. The thing is, the internet was absolutely the right idea. It's involved in almost every second of our lives. But if you bought internet companies at the wrong time, you lost 80% of your money if they survived. That was for the good ones, like Microsoft and Amazon, to say nothing of the ones that vaporized. And, it goes back to that incredible feature of financial markets that it can take a great idea and make it into a bad investment. I mean, as I say, I'm not a mathematician. From my very limited understanding, AI is extremely high-grade regression. And if that's correct, then it is going to be better than anything else on Earth at understanding the past, but unable to extrapolate that in anything other than a linear or a rational way. And you've seen a lot of waves of technology through time. People worry about the same things every time: jobs destruction, excessive returns to capital, deflation. We probably do get those. The question is, how soon? There are a series of great articles from the 1920s, a lot of hand-wringing by the kind of moral authorities of the day about how the younger generation were rotting their brains and wasting their time listening to the radio, and how that was kind of impeding their ability to think, and was just, it's just kind of a waste of time. Possibly they were saying the same thing after the invention of the printing press. So instinctively, I would treat it the same way as other technologies in the past in terms of their impact. The railway, a massively transformational technology, capex heavy in the same way that artificial intelligence is through data centers, power intensive, but resulted in a series of boom and busts on the stock market. So, I think you have to split the economic impact, which is, I think, much easier to gauge, from the investment quality, which, because markets are mass human psychology and they get very excited about things and they get very pessimistic about things, can make good ideas bad investments. It will undeniably become an essential part of our daily lives. It doesn't need to be an essential part of your daily portfolio. Probably not today, would be my view.
The last point on financial markets history and relating it to today that I wanted to cover is we live in a world of elevated geopolitical risks. When you look at history, those types of concerns have typically not had a long-term impact on financial markets. How do you think about that today, studying history?
I find geopolitics so difficult because the signal to noise ratio is awful. There are so many things that you're told to worry about that turn out to be totally irrelevant, but the impact, the magnitude of things that it is correct to worry about is very, very high. The thing is, governments are people, and people are unpredictable. So that makes it very difficult to have a good grasp. I try and educate myself about the institutions involved, the incentives involved, and the geography involved. Those are typically, I find, the most important lenses. I think a surprising amount can be explained by geography. And I think what you can say is that in 1990, you had an unusual moment, Francis Fukuyama's End of History, where you had a very large and very long-lasting peace dividend as the major Western economies demilitarized. You had a very significant tailwind of cheap commodities and energy out of the Soviet Union as that collapsed and all its products became available on world markets in a way that they weren't before. And you had very low sanctions and regulation on who could trade with whom. It became a pretty globalized world. And that itself results in cheaper prices for everyone. If you look at the profits made by the trading houses like Vitol, Trafigura, Glencore, Gunvor, those all kind of sprung into existence in the 70s when there were a lot of sanctions and restrictions on who could trade with whom. And they make billions and billions of dollars today after, a slightly fallow period because those trading barriers are starting to go back up. But in the 90s, they collapsed. China joined the WTO, the formation of GATT. Geopolitics became a non-event. And you had these huge disinflationary tailwinds take place for a very long time. I think all of those factors are reversing today. So I can't give you an opinion really on Israel v. Hamas, but I can tell you that the peace dividend is unwinding. Every major Western economy is remilitarizing, and that has a cost. It's money that has to come from somewhere else, or it's inflationary. The access to cheap commodities and energy out of the Soviet Union hit a pretty hard stop in February 2022. And the free movement of capital in and out of China is starting to be pretty restricted as well. The trading houses are once again making a lot of money, which tells you that goods travel is not that smooth around the world. So I think geopolitical risks are already present. The guys at the doomsday clock are always at kind of 5 seconds to midnight, right? It sort of goes from 4 seconds to midnight. They never get relaxed about it. Markets are typically relaxed about geopolitical risks because they've been paid to be so. But it's very hard to say in the short term, but if you zoom out and look at the atmospheric conditions, things are getting more stormy. I think the right way to play that is through trades that enjoy investments that enjoy rising inflation and rising volatility rather than specific geopolitical plays like oil. But it's definitely taking place.
I'd like to ask you about the U.S. stock market. It's enjoyed a tremendous run since the lows of the global financial crisis 15 years ago. It seems that these are great companies. All you have to do is just buy the S&P and forget the rest. It would be helpful if you could provide some perspective on long-term market cycles or super cycles and if you see any early signs of a potential inflection point.
The money question. I'll start off with an observation about where we are today, and then talk about how we might have got there. The first thing to say is that the real equity risk premium today is about 0.75%. So what does that mean? The excess of the earnings yield of the S&P over the 10-year TIPS bond is 75 basis points. So the 10-year is about 2.2% real yield, and the S&P earnings yield about 3%. Now, what that tells you, if we look back through time, historically, the equity risk premium at any given moment has been a reasonably good guide for what real annualized excess returns you should expect from investing in equities instead of investing in TIPS. So if that's correct, and on our website there's an article written by our head of investment strategy, Tern Dreismer, with the kind of the statistical backing of this. If that's correct, then the excess return you should expect every year for the reward you should expect for going from the bottom of the risk spectrum, US government debt, 10-year TIPS, to what is the top of the capital structure, S&P 500 equity, is 0.75% per year, which is to say very poor compensation for the extra risk. Now that's for context, that's an extremely low level. It was lower in the very peak of the dot-com bubble, when you had cheap bonds and very expensive equities. And it was about the same in the late 60s, early 70s. Again, a period I think that's relevant for today. And in both cases, the outcome was actually worse than 0.75%. Equities actually underperformed bonds for the next 10 years. So, the ERP is not a good guide on a 1-year view. It is a very good guide on a 10-year view. So from a sort of starting structural asset allocation perspective, US equities are expensive relative to US bonds. That's one point that's important to bear in mind. The second is to think about what the market dynamics have been. The QE era, the zero interest rate era, that was ultimately a bubble in bonds. So an underrated dynamic of the last 15 years has been that returns to size have been phenomenal and also sustainable because only big companies have bonds, can access the bond market. And so they've had a lower cost of debt than the rest of the market. Now, if you add into that David Einhorn's observation on the shift to passive investing and the fact that puts the most dollars into the biggest companies, then they've also had a lower cost of equity. So the last 15 years have seen big companies with a major competitive advantage, the ability to issue debt cheaper than anyone else, a lower cost of equity than anyone else, and they've used that to buy competitors. They've used that to lever up and buy back their own stock. As I said, if you can pay your employees in highly valued stock, there's possibly even a reflexivity to a higher share price. And they have phenomenal pricing power, these companies. That's the main attraction, is that as inflation goes up, they can put prices up too. Now, through all of history, companies with too much pricing power get taken apart by the government. The most famous example is Standard Oil, but it takes a political mood shift, takes a popular mood shift, to elect the people to do it, and we simply haven't had that. I think that's the big reason why Jeremy's mean reversion simply hasn't taken place yet. And to understand why and what might happen in the future, I think you have to look at demographics. We've been through a pretty much unique period where the largest asset owning class has also been the largest voting bloc. Normally what happens is that assets are owned by the elite, and the elite are not, certainly in a full franchise democracy, they're not the largest bloc at the ballot box, but by definition. But in eras when you had high wealth inequality and not full franchise, you typically had revolutions if the rich got too rich. Since the 90s, the boomer generation has had a lot of the household wealth, real estate and stocks, and they've also been the largest voting force. So you've had a very unusual period where the explicit policy of government has been to encourage returns to capital and to prevent anti-competitive forces, to prevent anti-monopoly forces. That has allowed these companies to stay big and keep their returns very, very high, but it has led to greater inequality. If you do own shares in these companies, you've done very well. In real terms, you've got a lot richer relative to the people who didn't own them. And there will come a time when enough people are voting, a majority of people who are voting don't have shares in these companies or don't have a stake in the wealth of the country. That's a very dangerous time. The middle of 2020 was when the millennials overtook the boomers as the largest population bloc in the United States. The average household wealth of the 18 to 34 age range in the United States is about $250,000. For the 65 to 74-year-old age range, it's nearly $2 million, a very large imbalance that will have to be slowly addressed through time. That is unlikely to be a dynamic that favors the current composition of the US stock market. Either anti-competitive forces will grow, as they have been in the European Union, where these companies aren't located, right? So the lobbying voices are more evenly balanced, or the owners of these assets, the older generation, who need to sell them in order to fund their healthcare, their cost of living as they retire, they'll have to sell them to someone. And the younger generation can't afford to buy the houses of the old. They can't afford to buy their shares. So either their wages need to go up a lot or their asset prices need to come down. And broadly, that's kind of how we've constructed portfolios at the moment. Protected against enduring inflation, which is almost certainly what happens if everyone's wages are going up, and mindful of asset price declines, which we think are probable, not possible, given the extent of overvaluation in particular US equity and credit markets.
What you just said relates to something you brought up earlier, and you alluded to, is this long-standing battle between capital and labor. And we know labor won in the 70s. That's when you had that, the rising wages and rising inflation, and capital has won more recently. And we know that the pendulum can swing to extremes. Where are we in that? You talked about it a little bit, but does it look like that's turning? And is your sense that it might go to the other extreme?
I think it's turning from an extreme point. It's the most important question. And it basically tells you in your portfolio, do you want financial assets like stocks and bonds, or do you want real assets like commodities and timber, farmland, that kind of thing? The head of the IMF, Olivier Blanchard, had a great quote, and he said, inflation is fundamentally the outcome of the distributional battle between companies, workers, and taxpayers. And it stops only when everyone is forced to accept the outcome. And I think what's going on at the moment is a distributional battle. A huge percentage of the profit share over the last 30, 40 years has gone to capital, to the owners of companies, to companies themselves, the managers of companies. And both governments and workers are now saying, okay, I think enough is enough. You are starting to see the first signs of inhibition on the free movement of capital and the free movement of technology. Those are both vital components to successful globalization. And if you look at China, there are soft curbs on American capital going into China. Your board of trustees will be asking you some pretty stern questions if you have a large allocation to China. And as we know, the US is attempting to deny Chinese access to vital modern technologies like semiconductors. So on the capital side, it's looking less positive, notwithstanding the fact that new technologies like AI tend to be moments of high returns to capital rather than labor. So we have to bear that in mind. But on the labor side, we've had a period in the UK where people were arguing for higher wages, getting those higher wages, then going on strike for even higher wages and getting those wage rises too. And I think most importantly, through all of that, enjoying popular support for what they were doing. There's a great saying from one of my favorite market strategists and commentators, a guy called Ben Hunt of Epsilon Theory. He says, shortages are the first sign of inflation in the wild. And I think that's a very simple rubric, very effective. If something is in shortage, it tells you that it's underpriced. There was no toilet paper in COVID because it was underpriced. If it were $50 a roll, it would have been you would have been able to buy it whenever you wanted. Labor is increasingly in short supply. People are hoarding labor. There's a kind of a great retirement going on. People are either retiring because of age or they're retiring because they don't see the point in participating in a capital market skewed against them. And so the returns to labor or the bargaining power of labor is going up. And there have been countless successful union wage negotiations in the United States over the last 24 months, right? When was the last time you could say that? So the pendulum is swinging, I think. I recommend to you and to anyone listening an incredible interview from 1994 between Charlie Rose and Sir James Goldsmith. And neither of those are particularly kind of clean characters, but the point he makes is to ask, what is the point of the economy? Do we work for it, or does it work for us? And I think since the 90s, we have worked for the economy. Capital has been the dominant force. I think COVID catalyzed, but was not the driver of, or it was a pre-existing force, a shift towards, well, actually, maybe the economy should work for us. And maybe higher wages, higher standards of living, lower inequality, those are things that public is keen on now. And in a democracy, what the public wants, it gets eventually. And the more that the system tries to prevent that from taking place, the higher the probability of a rupture of some kind. So, personally, I would see inflation as a good thing. I think that it's a very friendly way of having this capital to labor adjustment take place.
So let's dig into that a little bit more. One of the structural issues that we have is massive debt that's growing by the day as you have these unbelievably high deficits. So how do we, as an economy, get out of that cycle without stoking inflation and trying to do that while keeping rates low because we have so much debt? How does this game end?
The short answer is that it's very difficult. And you have to look at everyone's incentives. The historic way for dealing with very high debt burdens was to run quite high levels of inflation and keep interest rates quite low. So the economy kept functioning because interest rates were low, but real growth was typically negative because the inflation rate was so high. That does delever the economy quite quickly. However, there is a crucial caveat, which is that you have to artificially restrict the flow of capital and the supply of credit. And that is a bit that people forget, I think. We had interest rates run below the level of inflation, i.e. negative real yields, for all of the 2010s. And as a result, we had a debt kind of super cycle because, if the real cost of borrowing money is negative, you'd be insane not to do it, right? And hence, corporate leverage went up a long, long way. So to delever through inflation effectively, you have to have credit controls. I think that's a perfect example of the kind of unimaginable that was nonetheless, a very recent feature in markets. In the 60s, you had very stringent credit controls. Through a lot of the early part of the second half of the 20th century, you had credit controls. It was the government that directed credit in the economy. This part can have credit and can grow. This part needs to shrink. My dad has told me many times how if you went on holiday into Europe from the UK in the 60s and 70s, you could take £50 with you. That was kind of it. You weren't allowed to take capital out of the country. And so people had all kinds of complicated mechanisms for getting money out, but it was very difficult. So that's one answer to your question, one that's been tried before. The other one, which has also been tried before, is a kind of it's what a guy called strategist called Russell Napier calls phase 2 financial repression. So if phase 1 is interest rates below the rate of inflation, phase 2 is where you mandate the holders of assets to buy government bonds with their assets. So you kind of artificially bring down the cost of capital for normally the government. Now, that sounds pretty far-fetched. Surely the government can't do that. And the thing is, it can, and it has been doing it for a very long time. Things like the Basel series of bank regulations, the Solvency II requirements for insurers, broadly, they just compel savings institutions to increase the percentage of their assets that are held as government bonds. And it's a form of kind of implicit yield curve control. And I don't see any reason why that couldn't go further. In the UK, we've just had the launch of something called a British ISA. This is a kind of tax-protected wrapper where you can put money into it and any gains are free of capital gains tax, but you have to invest them in British assets. It would be a very simple piece of legislation in the US for them to say, if you want to keep the tax advantages of your 401k or your Roth IRA, you have to invest them only in US government bonds. That's a very effective way of pushing down the interest rate on US government debt. And it sounds ridiculous, but it has already happened, just to a more invisible extent. And it's certainly happened in the past with war bonds, war loans, that kind of thing. So the third way is that we discover a series of new and incredible technologies, like maybe AI and maybe nuclear fusion. And that just enables such remarkable economic growth that we're able to, through increased productivity, pay down the debt load. But That's very rare for that to happen in history, and typically it's accompanied by very significant population growth at the same time, which might be possible, but as Jeremy said on your podcast, resource depletion is a thing. We're confronting that as a species for the first time.
Yeah, it seems like the path of least resistance when you have too much debt is keep rates low to help you maintain your debt payments and your interest costs, and inflate your way out of your debt problem, because that's in some ways the least painful way to effectively default on those debts rather than outright default. It seems like if you just look at history, that's often the way things transpire. And if the government and all of the relevant players have the tools in order to engineer that, it seems that that's ultimately the outcome that should play out, or at least the highest probability of that outcome.
That's certainly what we think. If governments engineer a fall in nominal government bond yields, and markets start to price structurally higher levels of inflation, then that is a perfect scenario for inflation-linked bonds, which price off nominal bond yields plus break-evens, or minus break-evens. So that they are a core allocation in our portfolio, the TIPS and the British equivalent. In both cases, the very long-dated versions, the 30 and 50-year bonds, because that's where you get the real convexity.
Let's talk about inflation a little bit more. That's obviously the big topic over the last several years. And if we kind of zoom out and look at history, you've essentially had either falling or low and stable inflation for 30, 40 years. And you've discussed some perspectives on why that regime may be completely changing. Would you talk about your long-term views on inflation, and maybe get a little bit more specific compared to what we talked about earlier?
It can be simply summarized as the period from, let's call it 1995 to 2021 had a 2% ceiling on CPI, and the period from 2022 onwards will have a 2% floor on CPI. And if you break down the composition of that, for most of the 2000s and the 2010s, you had 3 to 4% per year services CPI. So that was the rise in the cost of supply-constrained goods like healthcare, education, that kind of thing. And you had -1 to -2% per year deflation in the cost of goods, in good CPI. And that was things where the supply capacity for those was increasing significantly, like TVs, fridges, washing machines. Those are things that have devalued very significantly in real terms. It doesn't always feel that way because of the technological improvement that is contained within the price. But $1,000 in 1995 did not buy you as capable a smartphone as you can buy today for $1,000. That's for sure. So plus 3 to 4 met -1 to -2 for a long time, and that gave you 1 to 2% CPI. Post COVID, the picture's been different, and it's important to state that it was changing pre-COVID, beginning in about 2016. The major disinflationary forces of the 2000s and 2010s were waning. So that was things like the vastly cheaper cost of labor in Asia relative to the developed world, the cheap commodities out of the Soviet Union, as I mentioned, the demographic dividend from huge numbers of younger people entering the workforce, and a big increase in female participation in the workforce. Plus, obviously, all of the incredible technological developments since the mid 90s, really. And most of those are now waning, if not actively reversing. And that means that you've got what is still 3 to 4% services CPI, but good CPI is where it used to be pre-1990s, which is around 2%. That means that to get overall inflation below 2, you're going to have to work really hard. That means tightening into and holding tight through a recession. A lot of demand needs to be destroyed to keep inflation below 2% on a sustained basis. And, as I said earlier, I just don't think that there is the appetite at the institutional level, i.e. the Fed, at the political level, i.e. the Treasury, or at the popular level, i.e. the voting base. People feel like inflation has kind of been vanquished, and they've been right so far. I think unarguably the inflation has been transitory. The thing is, if you study inflation through human history, it's always in the shape of sine waves. It's never a straight line. It's never bang, you go from low to high inflation. It's always higher highs and higher lows in inflation. You think it's gone away. You get a kind of George Bush style mission accomplished aircraft carrier moment. And that was kind of December for the Federal Reserve. They said, look, it's gone. We can start cutting. And then either you do start cutting and you realize that actually you hadn't finished dealing with it. Like a weed in the garden, you just kind of cut the top off. Or it comes back before you can even get there, which is what the market was sort of grappling with for the first 4 months of this year. I don't know which it will be, but I have high conviction that it's one of those two. And most importantly, the market believes the opposite. So you're given a great asymmetric investment opportunity to take that view.
My experience is they tend to be very slow to price in regime changes because it's very easy to assume that the future is going to resemble the recent past, and markets will revert back to wherever they were as their normal resting place. Unlike what often happens when you get these regime changes, is it takes a while for the market to recognize that. And in some ways, you can see that now with, you mentioned earlier, markets discounting, roughly 2% inflation for 30 years, and not fully recognizing the forces that allowed the inflation to be, a 2% ceiling for multiple decades. And a lot of those have clearly changed.
Exactly. And markets give the money to the people who have done best in the previous cycle, right? The people who have the most money at the moment to manage, the people who have been most successful, are the ones who said, yeah, inflation is coming back down to 2 and staying there. And so regime changes always catch markets on the hop because the people who were most successful in the previous regime were those who most rigidly denied the possibility of a future regime shift. And that's why it's always, they tend to be such high vol moments, because the market, having been pretty certain about one outcome, suddenly incrementally starts to price a very different outcome. And volatility is just the result of uncertainty, basically. And that's, I think, the most high conviction thing you can say about inflation is that it will be more volatile than previously. And the thing is that volatility, an expectation of future volatility, has almost exactly the same price and asset allocation impact as actual future higher prices. Risk premia have to rise. You have to demand a cheaper price for the thing you're buying to reflect that future uncertainty. And that would basically be my one-line summary of the market today. Almost all risk premia are very, very low, as the market is extremely certain about future outcomes for inflation, for the economy, for geopolitics, for everything. To me, that doesn't seem right. I think the market should price more uncertainty right now. And, very importantly, because it's obviously a critical input into risk premia, the risk-free rate, the interest rate that you're paid to not take a view is, especially in real terms, extremely, extremely high. And so, we have a portfolio, because we're unbenchmarked, unconstrained, that is currently highly allocated to cash, to US floating rate treasury notes, because it gives you the optionality that cash always gives you. But at the moment, it gives you a very high return as well, especially risk adjusted. You are literally paid to wait in a way that you haven't been in more than a decade.
The other assumption I feel investors are making is based on recent history is the so-called Fed put, meaning you get a downturn and the Fed will cut rates, and that's become its reaction function over the last 30 years. That could be very different if inflation stays elevated. It hamstrings them from automatically cutting and providing stimulus when there's a cost to doing that. Which didn't exist for the last 30 plus years, but today could be a real issue.
Correct. And actually, I don't think it will stop them from doing something. If you look at the reaction to SVB, pretty small bank, immediately bailed out, as in depositors guaranteed immediately, at a point when inflation was nearly in double digits. I think that tells you that the Federal Reserve has a total priority for financial market stability over price stability at the moment. That will change in the future. I think there are two tricky bits in thinking through what you've said. The first is, if it's correct that the US economy is highly reflexive, i.e. economic outcomes are sensitive to asset price inputs, then even a modest decline in financial markets could start to kick off quite a self-reinforcing decline in the economy, which would then lead to further asset market declines and so on. And secondly, markets do have to be careful what they wish for when it comes to Fed stimulus. If they obviously overdo it, which is the playbook, as you say, and the government does the same thing, that is when risk premia could actually counterintuitively start to rise. The market might say, well, this policy setting, zero rates, is just inappropriate for, sure, it's a recession, but we're at 3.5% inflation. The deficit goes to 10%. That is when questions start to get asked about the ability of the government to fund itself. We saw those briefly last year. We have to be careful about asserting that the game hasn't changed and that the standard rescue the market playbook will work.
That takes me to currencies. How do you think about currencies, including gold and crypto, in today's environment, and which ones look most attractive to you?
Our founder, Jonathan Ruffer, often says, if you have a strong view about a currency, then you should go lie down in a dark room for 30 minutes. And when you get back up, see if you still hold it. I.e., they're difficult to predict. I would split them between hard currencies, such as gold, and personally, I would put Bitcoin in that camp. I don't really see any difference whatsoever between gold and Bitcoin, other than sort of length of track record. I don't hold either myself, but to me, they're both just supply constrained assets with zero intrinsic value that humanity has elected to place a value on. There's nothing to differentiate between the two of them. But, or paintings, they're kind of all the same thing. And those are good hedges against currency debasement. It is always very interesting to look at prices in gold terms. If you take oil, for example, in the 1950s, an ounce of gold bought you 20 barrels of oil. And today, it does the same thing. Now, you might think the gold price has gone up a lot in the meantime, oil price has gone up a lot in the meantime. That's actually just the dollar messing you about. Now, in periods when the oil price went up a lot, like the 70s, an ounce of gold bought you 10 barrels of oil. And then in the 80s, an ounce of gold bought you 30 barrels of oil. But it's a pretty narrow range. And so a lot of prices can just be messed about by what fiat is doing. If you look at the Dow Jones, which is the index with the longest history, the index price in gold terms was around 5 in 1920, and it is just over 100 today, total return. So 20-fold increase, about 3% a year, roughly. I think that's the right way to think about what a non-debased currency should deliver, putting your money, into capital markets. It's not the much higher numbers that people quote, like 7, 8 for the long-term return on equity. A big part of that is it's what the currency is doing. So that kind of informs the second part of my answer. Which are the best fiat currencies? There aren't many good ones.
I've referred to it in the past as an ugly contest. The least ugly wins.
I think the country that can most cope with high interest rates is likely to be the best place to put your money if you must hold fiat. That's probably the United States. It's got great domestic resource availability. It's got a capital-friendly political system and legal structure. It's got a lot of immigration. It's got very high innovation, and debt levels are not ridiculous in the real economy. Households are pretty de-geared. The corporate sector is geared, but less so on a net basis, and the government is indebted, but not ridiculously. I think financial markets are the main risk in the United States, but somewhere like France, China, Brazil, these are places where debt levels are very, very high, and so the ability of the economy to cope with high rates is very low. So the probability that they run excessively low real yields to help with that is high. They're places that I would not want to have capital in the currency. The big question is what to do with the biggest short vol trade in human history, which is the Japanese yen. They're still at zero rates. It's kind of unbelievable. And their currency tells you that is a slightly inappropriate policy setting. But also that it's not easy for them to get out of that. I think what you want in a currency is something that is asset backed. Does it have good economy behind it? Does it have good savings behind it? Does it have what looks like an accelerating nominal cycle taking place? Japan ticks all of those boxes. There are kind of tailwind dynamics, like the fact that a large number of Japanese corporates have stopped repatriating their dollar profits because they see the yen keeps declining. And Japanese savers have a huge amount of their savings abroad. On top of the fact that it's probably appropriate for Japan to enter a hiking cycle for the first time in ever. They have a lot of money that they could repatriate to Japan if those returns on capital start to rise. So although it's got a big government debt problem, we have a large allocation to the yen in portfolios in reflection of the fact that it looks to be a highly asymmetric currency investment.
Matt, you've been extremely generous with your time. Do you have any final thoughts to share or any advice or general advice for investors?
Thanks so much for all of your great questions. I only have one real piece of advice, which is to read widely. I think people can get wrapped up in very narrow financial market books on investing. If it's correct to say that markets are just human psychology writ large, and I think it is, then there's almost no book that isn't of relevance, right? Including all nonfiction, which helps you to understand human psychology from a different angle. I'm about to start reading a book about mushrooms, and I know that I will be surprised at the potential investment insights in that. I wouldn't say I hope it's not fiction. So, yeah, read widely. It widens your horizons and helps you to understand the wide links that you need to make for successful macro investing.
That's great. Matt, I appreciate your time. Thank you for joining us.
Thanks, Alex, and speak soon.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.